But apart from that, I do own Bitcoin, uh, and Tesla owns Bitcoin, SpaceX owns Bitcoin. Um,
Have you ever watched the news, scrolled through your feed, or listened to a podcast and found yourself dazzled by the seemingly astronomical wealth of billionaires like Elon Musk? One moment they're worth a cool few billion, and the next, they're clocking in at a staggering 100 billion. Ever wondered how they make that leap? Are they in possession of a secret money making formula that the rest of us aren't privy to? Or could it be that they're employing a financial strategy that most people aren't even aware of? In 2023, the man behind Tesla and SpaceX added around $180 billion to his net worth. Now, he didn't find a gold mine, nor did he stumble upon a hidden treasure. So how did this incredible wealth accumulation occur? Today, we're going to unravel this mystery. We're diving deep into the world of finance to expose the strategies billionaires like Elon Musk use to amass and leverage their wealth. It might sound like they're getting money for free, but as we'll explore, there's much more to this tale than meets the eye. Now, if you're as excited as we are to decode these financial strategies, give this video a thumbs up. If you have any thoughts, theories, or questions along the way, make sure to drop them in the comments below. Now let's get started by first understanding debt. You see, in the financial world, debt is like a double-edged sword. On one hand, it comes with an obligation to pay back, often with interest, but on the other hand, it can act as a powerful lever to catapult your financial gains, providing you with a sound strategy to manage it. That's right, it's the lever effect that makes debt so attractive for individuals and companies alike. For instance, let's look at Tesla, the tech giant led by Elon Musk. In January 2021, Tesla invested a whopping 1.5 billion in Bitcoin, all financed by debt. Now, this wasn't a gamble, but a calculated risk based on market trends and Bitcoin's potential growth. And voila, it paid off, earning Tesla an approximate $1 billion in paper profits, thereby illustrating how debt, when used wisely, can yield incredible returns. Now that we've gotten a grasp of understanding debt, let's delve deeper into a popular and smart strategy used by many wealthy individuals and corporations: stock collateralization. It is a method of borrowing money by using the shares you own as collateral. This is a clever strategy as it allows the borrower to access liquidity without having to sell off any of their shares, keeping their ownership intact. Now you might be asking, why would someone want to do this? The answer lies in the potential of capital appreciation. By holding on to their stocks while borrowing against them, wealthy individuals or companies can take advantage of the potential price increase of those shares in the long run. They maintain their equity position, reaping the benefits of price appreciation, dividends, or voting rights, all while accessing necessary funds for other ventures. Elon Musk himself is known to have used this strategy. Rather than selling off his Tesla shares, which could cause a decrease in Tesla's share price and his control over the company, Musk has often collateralized his shares to fund his other ambitious projects, such as SpaceX. Stock collateralization is a brilliant strategy, but it's not without its risks. If the value of the collateral decreases significantly, the borrower might have to deal with a margin call, requiring them to either post additional collateral or repay part of the loan. Now, let's talk about our case study on Elon Musk, the visionary billionaire, and how he used the power of debt and stock collateralization to seemingly get billions. Elon Musk, the man behind Tesla, SpaceX, and other revolutionary companies, is no stranger to using debt to finance his ambitious dreams. For instance, as we mentioned earlier, Tesla took on a substantial debt to invest in Bitcoin, which paid off with nearly $1 billion in profit. But how about his other massive billion? Here's where stock collateralization comes into play. Musk holds a considerable amount of Tesla stock. Instead of selling these shares, he's been known to borrow against them, thereby keeping his ownership intact while getting access to billions in liquidity. This method allows him to avoid any potential capital gains tax that would come from selling the shares while still having the necessary funds to invest in his other ambitious ventures. It's important to note, though, that this strategy involves risks. If Tesla's stock price were to fall drastically, Musk would face a margin call, which could force him to sell some of his shares. However, considering the solid performance of Tesla over the years, Musk's strategy seems to be paying off quite well. Musk's story provides us with a real-life example of how debt and stock collateralization can be leveraged effectively to accumulate wealth. But remember, it also requires an understanding of market trends and confidence in your own investments. If you learned something new about Elon Musk's strategy so far, don't forget to hit that like button. And if you have any questions or thoughts, drop them in the comments below. Let's get back to it. Alright, so we've discussed what stock collateralization is and how Elon Musk has successfully used it. But is this strategy only limited to the likes of Musk? Or is it something other wealthy individuals also commonly use? Well, borrowing against stock is a prevalent practice among the ultra wealthy. It's not just Musk. Many affluent individuals and business moguls have been using this strategy to effectively manage their wealth and finance their ventures. Why is this strategy so attractive to them, you ask? One reason is liquidity. As we've seen with Musk, collateralizing stocks provides a way to increase large sums of cash without selling any assets. This means they can fund new projects or cover personal expenses without losing their stake in their companies. Another critical reason is the tax advantage. In many jurisdictions, borrowing money isn't considered taxable income, whereas selling shares and realizing capital gains can lead to a significant tax bill. This allows the wealthy to access the value of their shares without paying the hefty taxes that would come with selling them. In a sense, it's a form of tax arbitrage that can save significant amounts of money in the long run. It's another example of how understanding financial tools can lead to substantial advantages. Aside from that, this method allows the wealthy to diversify their investments. By borrowing against their shares, they can invest in a variety of other assets, spreading the risk and potentially increasing their wealth even further. But as we've previously mentioned, there's a fair share of risk involved in this practice. If the stock prices dip significantly, it could lead to margin calls and potential financial difficulties. Borrowing against shares encourages a long-term perspective on investing. When investors take out a loan against their stock, they're incentivized to keep those stocks for a longer period, waiting for the market to rise and yield significant returns. This long-term approach aligns with many successful investor strategies, such as those of Warren Buffett, who once famously said, "Our favorite holding period is forever." Moreover, holding on to the stock means they continue to reap benefits like dividends and potential appreciation, which can further enhance their wealth and even help in repaying the loan. Now, let's touch on another essential part of this strategy, repaying the loan. When you borrow against your stocks, you will need to repay it eventually, but that's not necessarily a disadvantage. In fact, it could serve as another benefit. Why? Because often the interest rate on these loans is relatively low. This means that if the individual's investments can earn a higher return than the interest rate, they effectively make money on the borrowed funds. Moreover, the interest on such loans is sometimes tax deductible, which adds another layer of financial benefit. Remember, though, that while this strategy can offer significant advantages, it requires careful management and an in-depth understanding of the markets. It's a financial tool, not a guaranteed path to wealth. Now, let's talk about its simple process. You might think that a strategy like borrowing against your shares would involve a complex process, but you'd be surprised. The procedure is simpler than you might imagine, especially when compared to securing traditional loans. Typically, the process involves establishing a line of credit with a financial institution. The shares you own are used as collateral for the loan. The amount you can borrow is usually based on a percentage of the value of the shares, which is often up to 90%. The line of credit is then made available for the borrower to use as they see fit. This straightforward process is a considerable draw for many wealthy individuals, as it allows them to leverage their existing assets quickly and efficiently. Plus, there's no requirement for credit checks or lengthy loan approval processes, making it even more streamlined. But as with any financial strategy, it comes with risks. If the stock's value declines sharply, the borrower may need to post additional collateral or repay part of the loan. This is where financial acumen and a keen understanding of market trends come into play. And if you're enjoying this video and learning a lot, hit that like button and let us know your thoughts in the comments. So, is this trend of borrowing against shares becoming more normalized? Well, yes. With the global rise of tech giants and their astronomical valuations, many billionaires are leveraging their stock holdings for liquidity. Given the immense benefits and simplicity of the process, it's no wonder that this trend has seen substantial growth and is becoming normalized among the ultra-wealthy. As the wealth gap continues to grow, this financial maneuver becomes increasingly prevalent, further fueling the trend. It's yet another testament to how the rich use financial strategies to preserve and grow their wealth in unique ways. Borrowing against shares, like any financial decision, must be made with due diligence. It's crucial to evaluate the associated risks before committing. Remember, if the value of your stock plummets, you could face a margin call, requiring you to either deposit more cash or sell some of your shares to balance the loan. So, as much as it's a smart move for wealth building, it's not without risk. As Benjamin Franklin wisely stated, an investment in knowledge pays the best interest. Therefore, always invest time to fully understand the terms of the loan and, if needed, consult a financial advisor. Also, keep in mind the success of this strategy often depends on market conditions and the specific nature of your stocks. Companies with stable, long term growth prospects tend to be safer for such practices, while volatile stocks can introduce a greater level of risk. Borrowing against your shares can be an ingenious way to maximize your wealth as long as you're prepared to manage the inherent risks. So if you found this information helpful or insightful, be sure to hit that like button and share it with others who might benefit. Also, don't forget to subscribe and hit the notification bell so you don't miss out on future content like this. Do you have any experience with stock collateralized loans? Let us know in the comments below. Stay informed, stay smart, and keep growing. Until next time.